Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Steve Wyett, Chief Investment Strategist at BOK Financial. We'll take a look at Fed policy and his outlook for 2023. Steve, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. Thank you for having me back. Appreciate the opportunity.
You got it. And how do you think Fed policy is playing out? What's the most important thing that the Fed is focused on right now?
Yeah, it's really interesting how things have worked out with the FOMC meeting just last week. And I thought Fed Chair Powell was trying to be very clear on what his outlook was for what the Fed was going to try and accomplish over the next 12 months. The markets, I'm not so sure, are completely buying into what Fed Chair Powell is saying. If you just look at how the bond market responded after, I don't know what else Fed Chair Powell is supposed to say, that, the terminal rate's going to be above 5%. They think that they're going to be able to keep interest rates above 5 for the balance of the year. And Jill, I would have to say that I would define that as a win for the Fed. And the reason that I say that is that if the bond market turns out to be a little bit more right, which is calling for the Fed to pivot earlier than what Fed Chair Powell is saying, what the bond market's really saying is that the economic outcome is going to be worse than what the Fed is thinking. And so I'm not sure that's the outcome the Fed wants. It's not the outcome we would want. And if you look at how the equity market responded in the back half of last week, I think they started to pay attention a little bit because, if rates are lower and inflation is lower, in some ways that could be good for equities, but not if it's because the economic outcome has been very bad, which would take just at that point, the decline in earnings and economic activity can't overcome the improvement in the valuation of lower interest rates.
Steve, it's interesting that you point that out because to your point, I'm not quite sure what else the Fed can articulate about its strategy. They haven't said anything new, if anything, perhaps reminding market participants that this is a course we're taking. We are not going to reverse course because one data point is not a strategy make. We don't want to make the mistakes that we saw, a number of decades earlier. And the market just seems like it does not want to hear that, right? It's having a tantrum almost. And that's what makes it really tough for me to understand how this dynamic is playing out. So Steve, my question to you is what happens if inflation were to accelerate?
Well, look, I think part of this is that we've been conditioned over the last 15 years to think that a Fed pivot is going to be a good thing. That's part of it. I think the other part of it, Jill, is look, if we look at what our forecasts were 12 months ago at this time for where we would be sitting here today, and I think the Fed forecast was for rates to be at 75 basis points in December of this year, and inflation was going to be at like 2.1%. We know that their forecasts aren't going to be perfect. But I think that ultimately what the Fed is looking at is that it's the way inflation is structured today. I think there's a pretty good chance headline inflation could decline pretty quickly over the next few months. Energy prices are declining. We certainly have seen some reduction in commodity prices out there. There are retailers that are choking on inventory right now. There are parts of the economy where we're going to see some relief from the inflation side. But let's not forget the Fed's focused on core inflation. So even if headline inflation declines pretty quickly, they're going to be paying attention to core. I know rents, you can look at rents and say the latest data is that new rents that are being signed today are at lower rates. But man, rents really lagged as we were going on the way up. Rents were exploding higher and the rent part of inflation was lagging. So we look for the rent inflation to remain pretty firm. Wages are still firm. There are parts of the economy where people are getting laid off, but you just continue to look at the JOLTS data, 3.7% unemployment, news out of ExxonMobil where they give 9% raises. There's still going to be some wage pressures out there. And I think that's what the Fed is really concerned about. And they're just trying to say, look, this is going to take a little more time. This isn't going to be a V-shaped type of a move off the bottom. And that's different than where the market's been for some period of time.
Yeah, and that's a great point. And we've been so hyper-focused on what's happening with the macro, but let's think about earnings. It doesn't feel as if anything's rebased yet. And that could potentially be, is that a capitulation point once we get through earnings and estimates have come down, or they rebase that we can kind of move on from there because all of the bad news is out there?
It could, Jill, but look, here's the thing that it's hard to come up with a scenario where we think earnings in 2023 don't come down some. It's just a question of how much they're going to come down. That's why I think the message from the bond market could be so negative. But all of the things that the Fed have done this year, and by the way, the other thing, while we're talking a lot about rates, and even in Fed Chair Powell's press conference, very little talk about quantitative tightening, which could be the wild card in what's going on in the market out there. But just thinking about how this is going to flow through from an economic standpoint, even as inflation comes down, that means corporate revenues are going to decline, and they're probably going to decline faster than their cost structure because wages aren't going to go down at that same level. And so this is where we think margins come under a little bit of pressure overall. And you see, and as I say, you're just going to see, it's a question of how much earnings are going to come down. And until we get some clarity on that, it's really hard for us to think, okay, how do we build a valuation process to say this is where equities are fairly valued and move up from there. It's going to happen. Yeah. We're going to get through this. This isn't the end of the world kind of stuff. But there's just some things economically and from an earnings standpoint that we feel like we need to get through before you could really look and say that you're anything but somewhat cautious towards the equity market in 2023.
Mm-hmm. And that's a great point that you made about wages, because I remember you and I talking about this earlier, that the one thing that's definitely not transitory is wages. I mean, you can't really detract wages and take that away from people. What about the fixed income market? What are your thoughts there?
The fixed income market is closer. Now, again, the fixed income market is kind of pushing back against the Fed. But in general, if we just look at cash flows that we can now generate on fixed income, they look better than they have in 15 years. It may very well be that the 2-year note still has some work to do on the high side, but the majority of the damage is done. I'm not trying to mitigate the pain that we went through in 2022, double-digit declines across many of the fixed income markets. And look, on 10 longer-term treasuries, those markets are down more than equity. So it's been a really painful process to get here. But as we look forward from here, just from an investment management standpoint, if we think about bonds, which is not really where in the past we've looked for big capital gains or to drive big returns, but to generate cash flows that help us fund distribution requests and the kinds of things that as a retiree, I can fund my retirement without having to sell something to do that. The bond market looks a whole lot better, and the Fed's close. Even if they get to 5.25, we're a lot closer on the bond market, we think, from a valuation standpoint than where we may be on the equity markets as we move into 2023.
And Steve, to wrap up here, any other macro trends or any other items that investors should be aware of?
Well, I think, look, there are some big trends that are going to be taking place over the next few years. I think deglobalization, this idea of a multipolar economy, I think that's going to be with us for a long period of time. You just recently saw Apple announce that they're moving production out of China. Now it's going to Vietnam and India, but there's other companies that are going to do that. Reshore jobs, friendshoring was how I heard it put over the weekend. That makes a little sense to me. But the fact of the matter is, the pandemic and China's response to COVID, it certainly highlighted the risk for many businesses out there to have the vast majority of their production in one place across an ocean that you've got to worry about getting your products to your clients. I think that, and with Russia invading Ukraine, Russia and China maybe aligning a little bit more, even Saudi Arabia looking to agree to sell oil to China denominated in yuan. All of these are things that, again, it's not the end of the dollar's dominance in the global economy, but just on the margin, these are some things that we think we need to be aware of as we move forward. That's not all bad for the U.S. Globalization was not all good for the U.S. I think it presents some real opportunities as we think about moving forward. And I would tell you, Jill, the border in Mexico is getting a lot of publicity these days with what's going on in Section 42 getting ready to come off. I'm going to wish, my New Year's wish is going to be that our leaders in Washington can find a way to get together and come up with a reasonable immigration policy. We've got millions of people wanting to come to this country to work. We need workers. I'd love to see us find a way to allow those immigrants to fill jobs in the United States, actually improve the production capacity of the economy. And that might actually take some pressure off the Fed because they're just trying to lower demand. Let's do something that might actually help from a supply standpoint. And I think that would benefit everybody regardless of your political stripe.
Oh, Steve, such an excellent point. We appreciate your insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.